The difference between accumulation and decumulation or use in retirement is dramatic. Accumulating wealth was a very almost formulaic. The biggest number, which we missed in most parts, was the savings rate. How many times sponsors have said no to auto escalation? It makes my hair curl.
Yeah.
When they could, but they're willing to match just 1% to 3%. I'm like, well, why don't you just spread that to 10?
Yeah.
It actually will financially be better for you, and you're doing the right thing for your employee. No. It's their money. They got to make. So I'm still my biggest bugaboo of the last 40 years is that we haven't really accelerated the savings rate automatically. We put people in plans, we put them in thoughtful defaults, but the biggest thing that mattered was savings rate. I'll get off that soapbox because now we are where we are, right? The balances are what they are. Sadly, just as much as there is a high propensity of $1 million rollovers, there's also a high propensity of $100,000 60-year-olds. Now it went from $40,000 a year in the 4% rule to 4%. That's so. To your point with the this potential for conflict, I think income in retirement is the thing now, right? That's what everybody. What's my number? What is? It's only $4,000 a year. Holy cow! Or it's $40,000. I better be really mindful how I spend that. It's so individualized and nuanced because of their family situation, both in the family they're in, as growing a family, or older parents, or health. I mean, it's hard to take what was a fairly homogeneous outcome and decision in establishing a plan and getting into the accumulation of wealth. Now it's individual, and people are going to have to be involved. There's going to be some element that can be robotic. Or I think the bigger trend is we're going to see these big insurance companies create an income and retirement stream right from the plan, which creates another conflict to your earlier point of the advisor feeling like, oh, what about me? And those advisors are going to have to figure that out because that's clearly going to happen, and if not already happening. And it's hard to say, and I love advisors. A lot of these are friends that I've known for 40 years. Some are doing a really good job of trying to insert wealth management into their local offices, and others are still really busy with other outcomes, like creating a better outcome for small plans in massive scale. I know a couple of firms that are just full on focused on getting that done, including the benefits of corporate insurance in running the company. The personal decision at retirement is going to be the hardest one to scale.
I think the question is, how many hats should a fiduciary wear? Right? I mean, that's a circular discussion, but
Yeah.
I mean, the more hats we wear as a fiduciary, the more potential conflict that we introduce. But that's number one.
Yeah. And again, unlike the pension plan, where the pensioner is at the behest of the pensioner all the way through that final pension check or beneficiary's pension check, right? That's a very different equation in the defined contribution plan.
For sure.
And the fiduciary, how much will the fiduciary allow that decision to create an income stream from the plan do they want? I know that's a decision too. I'm sure it'll be an optional choice. And I think that's ultimately the beauty of the DC plan is that it is up to the individual. The sad reality as a society, we're not really as financially literate as we should be. We think we can go out and buy that $100,000 income stream.
Yeah.
Well, you can't just buy it. You can't write a check for that. You got to have the money that backs up that the insurance company is willing to take the risk on you to provide you that income stream. People don't get that. It's like, oh, I'll just worry about that later. Well, if you don't have any money, you can't buy an income stream. I think there's a reason the insurance companies have really concentrated on getting as many plans and participants as they can. And I think, what institutional grade is coming to insurance too. We saw this at one firm I worked at as we built an income and retirement construct off our target date fund, where they kind of figured out the math too. Like, oh yeah, you're providing us scale and volume. So instead of this price point, which we would charge retail, we can charge you this, which was a big difference. Yes. So again, I think through because of the need that we're facing and the size of the population against the need, and the transparency requirements that are clear under fiduciary, I mean, broadly said under a fiduciary guidance, that's going to be helpful to what's been helpful to the sponsor is going to be helpful to the participant, I think, in the IRA space. I think you'll see an IRA fiduciary governance expectation or in plan distribution expectation.
I hope that happens. I hope that happens. I think that, again,
Makes sense.
we need to be faithful to protecting the sole interests of participants who worked
And
their
if
whole
you
life.
live by that rule and believe that rule, you're going to do really well because
Exactly.
we've all done enrollment meetings. What's the number one question after you say, I represent my company and by law, I can't tell you what to do?
Right.
And the line forms at the end of the room, and what they all ask us?
What should I do?
What do I do? Now,
been there too many times.
yes.
And I think that to your point about personalization, you didn't use that word, but the idea of when you're accumulating, hey, time value of money and miracle of compound interest, having the right allocation should get you there.
Yeah.
Decumulation is a totally different thing.
However,
and I think,
right to that point, what happens when you change jobs and didn't roll into the new plan and you've got 6 balances out there? You may not even know you have 6 balances out there, which is a little concerning. But all those calculations are wrong because you're not taking into account all. And what about your spouse? What about any inheritance that you might have or whatever? And that's why the personal element, and I think that, dare I say, it becomes more of a high net worth thing. But I think it does become a little bit more, the opportunity for the advisors is to really wire well the true financial wellness elements that many Americans are fortunate enough to experience and do it really well. And they will do really well because of that.
At the end, is go back to data, collecting data.
It's all about the data.
Having real data and then using the data correctly, prudently to inform decisions. Again.
And that was our decision, Philip, is, okay, do we want to try to tackle that big challenge for participants or do we want to tackle the problems inside the plan? Because we now literally live inside these record keepers. We're getting their data. We're to the point where we can actually help evaluate the plan before a problem's known and go look for it. And that's, we feel our responsibility. If we get that right, that the downstream implication is kind of clear from a participant level.
Enormous.
Yeah, it's what you opened there with IRAs and self-interest and this cross connect between advisors and the record keepers and the sponsors and the participants. Man, this is where we are now. Getting this right is our challenge.
It's where we are, and we need to make sure, in my opinion, that fiduciary is not I'm a pepper, you are a pepper, everybody's a pepper. That not everybody is a pepper, not because they're right or wrong. It's just that not everybody can be or should be.
No, it was easier when we were growing wealth. It's very different now as you've come to that point in your life and what you've accumulated, how you're going to use it for yourself and your family. That's a very personal decision.
Very different. And also, I think it can be very confusing. I mean, if you think, like you and I think, that investing is confusing.
Try figuring out your Social Security.
Yeah, exactly.